So my starting point is always the TB of S. And I have in that starting point the 150,000 profit. How will I attribute that to the parent and NCI as two different classes of equity participants? You all agree, I can't say 150,000 Rand multiplied by 80%, multiplied by 20%, multiplied by 10%, multiplied by 90%, because I'll end up attributing 300,000 Rand through that process. So what I need to determine is how much of that 150,000 Rand is attributable to the preference shares. Please hear clearly, it's not how much dividend was declared. I'm not there. I am asking how much is attributable to, how much are they entitled to as preference shareholders. And based on the given information, you could calculate the preference dividend, the annual preference dividend, as 100,000 shares multiplied by 25 cents per share gave you the 25,000 Rand as my annual preference dividend. So I can exclude from the 150,000 Rand the 25,000 Rand as the portion attributable to the preference shares. What I'm left with is the portion attributable to the ordinary shares. That 125,000 Rand can now be attributed to the parent and NCI based on their 80%, 20% shareholding. And that gives me an amount of 100,000 for the parent and 25,000 for NCI. But I still have to attribute the full 150,000 of S. I have now only attributed 125,000. So remember to then also attribute that 25,000 Rand for the preference shareholders based on their percentages. Parent is now 10%, so that is 2,500. NCI in the preference shares is 90% holding, and that's an amount of 22,500. Now I've attributed the 150,000 Rand to all the equity participants. This will be your thought process behind deciding how much is attributable to the preference shares. But on top of that, if you remember, at some point I did mention that this process highly depends on whether the preference shares are cumulative or non-cumulative. I did not mention cumulative or non-cumulative in this example. We assumed it's cumulative, but let me explain the difference between the two. When you are dealing with a cumulative preference shareholder, you will attribute this 25,000 Rand of that profit of the subsidiary every year, regardless of whether the preference dividend was actually declared in that year or not. Remember, I said I'm busy attributing. I'm saying how much is attributable to the equity participants. I'm not dealing with the actual dividend declared yet. If it's a cumulative preference shareholder, you will exclude that 25,000 Rand from the profit for purposes of attributing to your equity participants every year, because your cumulative preference shareholders are entitled to that annual preference dividend regardless of whether it's declared or not. If you, however, are dealing with a non-cumulative preference shareholder, you will only do this where you attribute to the equity participants when the dividend was also declared. because your non-cumulative preference shareholders are only entitled. Their balance should only be affected with the dividend when the dividend was declared. The non-cumulative preference shareholders are only entitled to a dividend when it's also been declared. So please have a look out for that. In the examples in Chapter 8, we will look at scenarios when it's cumulative versus when it's non-cumulative. And it's important that you can identify the differences in the consolidation process when that is the case. In conclusion, before we now look at the detail of the examples in Chapter 8, the thought process that we will follow is really divided into 2 steps. Under step 1, this is where we attribute the equity. This is where we determine how much the equity participants are entitled to. The consolidation journal entries to give effect to this step is to take away from the equity of S and attribute that to the NCI so that you're left with the equity attributable to the owners of B. Take away from the profit attributable to the owners of the parent and attribute to NCI. In step 2, this is now where we look at the actual dividend declared. It's different from step 1. This is now where the dividend was declared, where we had an elimination of the income against the income recognized by the parent to reduce the income of the group as its intra-group, eliminate the full dividend declared by the subsidiary, and we end up with this debit movement to NCI, which is now representative of what they got back as equity participants. If you want to use the cake analogy just to understand this even more, under step 1, that is where we cut this cake into slices and we say this is what you are entitled to on a plate, this is your piece of the cake. In step 2, we can now say that's when you eat the cake. That is now what you are entitled to. You received it, you got the benefit, so your balance will reduce. Under step 1, it's typically where we increase the equity participant balances if it's positive movements in equity, and under step 2, we make their balances smaller again. In Chapter 8, this will now happen twice, step 1 and step 2. Last important concept, you only write a consolidation journal for NCI if their balance should change.